Personal Bank Show with Ferenc Toth, President and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. It's Ferenc, and I want to just wish everybody a great new year. Hope the holidays were awesome, and you had a great time you had to spend with your loved ones. I just want to point out real quickly that we had a couple of very special shows that aired actually around Christmas and New Year's. In fact, the the December 31st show, we really talked a lot about goal setting. Because New Year's resolutions, goals, those kinds of things are a very common theme, obviously, the beginning of the year. And the sad part about it all is this. Studies show, there's many studies show that lots of people make New Year's resolutions, if you will, or goals or that type of thing. And by the way, this is already, we're in the first week of the year, and the sad fact is a good percentage of the people, depending on which study you look at, have already given up on their New Year's resolution, and we're only about a week or so into the year. How do you take those good intentions, those New Year's resolutions, and turn them into something that sticks and really, makes a change in your life? And we talked a lot about that in the last show, and I would recommend, if you want more information on this, go to yourpersonalbank.com and look up the December 31st show, where we spent the entire hour on goal setting and how to make this stick. I learned a lot of this stuff originally from Peter Daniels. He's written a number of books. He was, at the time I've heard him speak, second richest gentleman in Australia. It was life-changing for me, and I've shared this goal setting, the wheel of life, and that type of thing for, about almost 2 decades with our company, with our agents, our sales force, our staff, and they've just really, even though many of them have heard it year after year, asked me to share it again because it's so powerful. And it makes such a difference. And, a lot of us have heard some of these things, but it's good always to refresh. The bottom line is this. When you set a goal, the key is it has to be written down. There's so many different sources that talk about write your goals down. I don't think anyone can argue that it's not an effective technique. And have them in a place where you can regularly see them. I recommend, personally, have your goals written down and put on your desktop, because a lot of people are on their computer a lot every day, so that it's right there in front of you and reminds you of what you intended to do. What do you want to accomplish? And, of course, after you write the goals down and have them somewhere readily available, you want to, have an action plan. What's your plan of attack each day, each week, each month to accomplish those goals? And have that, again, written down in a place that you can regularly check and review and rate yourself, if you will. Give yourself a score or a letter grade or something like that on how you've accomplished that. And like I said, if it's a daily, weekly, or monthly checklist, whichever is appropriate for you, do that. And then, of course, have an accountability. In other words, it can't just be you. If you're going to make a change in your life, habits die hard. Bad habits and good habits are not the easiest things to change, but repetition will change them. And many people, many studies, many books talk about making changes. If you start a new habit and you repeat that habit 21 times, 3 weeks in a row, it tends to become a new habit. I don't know if that's the exact time frame, but certainly not a bad thing to accomplish. And again, that accountability is somebody you respect, whether it's a spouse or a family friend or a mentor of yours, somebody that you don't want to disappoint, if you know what I'm trying to say, because that'll keep you more on track of accomplishing that new goal, that new habit that you wanted to accomplish. That's so powerful, because why you got to remind yourself, why did you set that goal in the first place? Why did you do that? What was it that you wanted to change or improve in your life? And of course, the last piece of it is you have to give yourself a reward system, and whether it's small rewards, weekly or monthly, or bigger ones, a combination of the above is best. An annual reward, let's say. And the reason the reward system is so important is, that takes care of the subconscious. It gets your subconscious mind going. There's a lot of psychology behind all that. I'm not going to spend the time here today to go into all that, but it's so important to do those things if you really want to change the direction, your habits of your future. And that's really what it boils down to. So again, go back to, go to yourpersonalbank.com, listen to the 1231 previously recorded show, and you'll go into a whole lot. We go into a whole lot about how that works and how to be successful at goal setting to make it stick. Okay. And that's really what it boils down to. And this has been a big part of my life over the last 20 plus years of making changes and haven't been perfect. No one's perfect. That's okay. But making a lot of those changes stick, if you know what I mean, and being consistent. And that's the key to being success on that. And with all that, and I guess I've got a point I'm trying to make here. And that point is this. With all the goal setting and all those types of things and how to make them stick, one of the things I encourage people to do and challenge them to do was learn something new. Reading books is important. Learn something new this year. And one of the things I'm excited about in sharing the personal bank concept is everywhere I go, whether I'm speaking to a workshop, a group of people, investors, individuals, whatever it may be, I get constantly, wow, this is new, fresh, different than the mantra that we've heard from the financial and investment community everywhere else. And yes, it is new. It's actually not new. It's been around. We're actually teaching people how to invest some of their monies like our parents and grandparents often did. Okay. And I share this all the time. This is a tool that's commonly used with banks. As a board member of a bank, I can tell you, one of our big shot consultants came in one time at a board meeting a few months ago. He's sharing with us the different things that banks can invest in. There's tier 1 capital, and there's certain things that FDIC allows. There's all types of rules. There's lots of limitations on what a traditional bank can invest in. And what was funny in that whole presentation that this, like I said, this is a bank consultant, 30 plus years. He works with banks of all stripes and sizes, big names, small names, you name it. And he was sharing with us all the different tools. And then it was funny. He saved this one for last. He says, and then when I work with new bank boards, he goes, this is a tool that's often used, much more often than most people realize in the banking world. But most new boards are very unfamiliar with unless they've been in corporate finance or in banking before. And he called it bank-owned life insurance, or BOLI. There's a whole term for it. And basically what that is it's a high cash value insurance tool, similar to what we talked about with the personal bank, for exactly the same thing, basically. And the key is growing cash, okay, obviously, which is our goal here, to maximize cash, minimize death benefit within the MEC rules, the modified endowment contract rules. It basically falls into the same type of thought process, and it was kind of funny, and I had to laugh when I was in that meeting and this big bank consultant sharing this, and I said, well, actually, I've been teaching this for years to my clients, and he said, wow, he was surprised, and he goes, well, that's great. He goes, that means you're way ahead of most new bank boards in terms of this area of finances. I said, yeah, I've got a pretty good handle on how this operates. And, of course, we did. So it's kind of exciting just to see and verify. This was first-person experience where I'm working with a big bank consultant sharing the same concept, the same idea of high cash value to grow your money, tax-favored, have access to the funds. I mean, the banks are using it as their cash reserves. What are they investing their money in, right? And this is a portion or a good chunk of what many banks actually invest their money in. So many people say, well, I haven't heard about this. That's one of the most common questions I get. And there's several reasons behind why you, in most cases, when I sit down with somebody individually or a group or whatever, why the vast majority, in my experience, are not familiar with or have not heard about the personal bank concept. And keeping in line with that thought and that idea of learning something new for 2020, this could be something that could enhance the financial future for you, your business, your family, and create a legacy, unlike just about any other tool can do. So in the next segment, we're going to talk about why haven't we heard about it and more about how does your personal bank work.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. to Your Personal Bank Show with President and Founder of Secure Estate Management, Ferenc Toth.
Welcome back to Your Personal Bank Show. And we were just talking about a little bit about goal setting. Again, if you want to get more information on that, listen to the previously recorded show. Go to yourpersonalbank.com, the 1231 New Year's Eve show. We spent the entire hour on goal setting and how to make those New Year's resolutions stick. The next thing I really want to touch on is how does your personal bank work? Because in the goal setting sessions and things we were talking about, is one of the things I encouraged and challenged people to do is, hey, take this year to learn something new. And your personal bank, for the majority of people that I encounter, this is something new, fresh, different. And it's a tool, a financial tool that I find most people are not using. And this can be a tremendous tool that can really, again, enhance their financial future. It's commonly used by banks. I shared my experience with the bank we're in the process of forming. I'm chairman of the board of a bank in formation currently. And, it's also used by corporations, businesses, and things like that for executive benefit programs and those types of things often. Wealthy families have been using this for quite some time, in many cases well over a century. So it's not a new idea, actually. It's just new to a lot of the people that I encounter. And there's a lot of reasons behind that. But before I jump into why, maybe a lot of folks haven't heard about it, really probably should share, how does your personal bank work? If you've listened to some of the previous shows, I've covered some of this, but it doesn't hurt to quickly refresh. How does your personal bank work? And by the way, if you're wanting more information on this, I'm going to be actually doing a couple of workshops coming up in Chicago. I'm going to be doing an introduction actually tomorrow on the 8th. An intro to your personal bank, and then a workshop, a half-day workshop on the Saturday, the 18th, January 18th. In Phoenix, I'm going to be doing a workshop on Saturday, January 25th. So go to yourpersonalbankworkshop.com to register. It's free. And like I said, we go from 10 to 1, and I basically spend a lot of time and go into depth on how your personal bank works and how it can really change your financial future. Again, that's yourpersonalbankworkshop.com. Register. It's free. Love to see you. How does your personal bank work? The quick and simple thing is this. If you're going to understand how to operate like a bank, the first thing I got to teach you is how to think like a banker versus an investor. Okay? This is a key thing. Because so many of us are taught how to think like investors. That's all we've been taught our whole lives. And again, there's a lot of reasons for that, which I'm not going to get into at the moment, but I've done before, but we can again. The bottom line is thinking like a banker. And why is it so important to think like a banker or understand how a banker thinks? Well, again, you can like banks or hate them. It's not really important. But I think we can all agree that banks are savvy about money. They understand money. And more than anything else, the banking industry understands they're very risk adverse when it comes to money. They look at money in more different ways than any other industry. And that's just a fact from experience. And I've stated that fact, and they agree with that. They're risk adverse, okay? Now, does it mean they don't make money? See, a lot of people in the investment community think, well, if you're risk adverse, that means you don't make much. That's not necessarily the case. I think we can agree that banks, for the most part, are pretty profitable too. So you can be risk adverse, yet you can have nice returns. Okay, what is it? What is the key about thinking like a banker versus an investor? Well, it's real simple. Thinking like a banker works like this. Or I should say this. First of all, how do most investors operate? Well, they trade hard-earned dollars for assets in most cases with the expectation that the asset will increase in value, right? So, again, I find in most cases, most investors focus on the potential gains only. They create little or no cash flow in most cases and rarely ask, what's my recourse if things go wrong? And I always ask people, I love doing this. It's kind of funny. It's like, if you purchase a stock or a real piece of real estate or a business, whatever it may be, can you tell me what it would be worth in a year or 3 or 5? And the reality is, the answer is no. You don't know. You can look at charts. You can guesstimate. There's all those kinds of things, but no one really knows what that asset is going to be worth a year, 3, 5 from now, do they? Too many variables, too many unknowns. And this isn't from me, but this is from actually a number of different books. I mentioned some of them in the last broadcast, but the bottom line is investing primarily for appreciation is just another form of gambling. In other words, if the only way you can make money is it goes up in value, what's the difference? And if it goes down, you lose. What's the difference of investing versus going to Vegas, for example, and put it on the roulette wheel? They got a point, okay? So that's how most investors operate. How do bankers think? Understand, bankers think about money differently than the typical investor. Have you ever taken a mortgage or a car loan? And I think in most cases, most of us, at some point in our lives, we've done that. And when we did that loan, we signed some papers, right? When you signed those papers, did you know you were going to have a payment? And the answer is yes, of course you did. Now, did you plan to make those payments? And the answer again is, of course you did. Otherwise, you would not be signing the papers, right? And in fact, you just went through a whole approval process to get approved for the loan. So guess what? The lender or the banker has a pretty darn good idea that you're going to make those payments with a very high degree of likelihood. Now, in the off chance you didn't make those payments for that car or that house, what would have happened? Well, eventually, they would take it back, right? They would repossess or whatnot, foreclosures, those kind of fun things, which are not so fun. Now, if you think about this a minute, is the banker really risking their money? What I'm trying to say is, think about this a minute. They're creating a secure cash flow. Cash flow is the key. Appreciation, paper accumulation is nice, but guess what? We need cash. We need income at all stages through our life. We talk about this all the time, not just in retirement, but in every stage of our life. We need income, don't we? We need money to live on, to pay the bills and keep a roof over our head and all that fun stuff, right? So we need income. So income is the key, not appreciation. Appreciation's nice, and I'm not saying appreciation's not important, but it's not the key, most important thing for most people financially in their lives. It's income, cash flow. So what's the bank doing when they approve you for that car or home loan? They're getting your payments, which is cash flow, and then they're securing the downside by if you don't pay them, they'll take the asset, sell it to somebody else, and create cash flow from payments from someone else, right? So that's why I say, when banks, are they really risking their money? In most cases, the answer is no. It's a collateralized loan. It's a protected asset, okay? So how does a bank work, personal bank work? It's real simple. When you get a check, what's the first thing you do with it? Well, we all deposit it in the bank, right? And what does a bank do with our monies? Well, they loan it out. Compound interest, cars, houses, credit cards, all that fun stuff, right? Now, here's the crux of the matter. What do banks really do? And again, I ask this question all the time, and literally, easily, 80 to 90% of the time, people don't know this answer. And I say, look, let's say you walked in the bank and you opened an account. You gave them money. You opened some kind of account at the bank. Then the next person walks in the door and gets a car loan. They get approved for a car loan. Does the banker just take the cash that you just gave them, turn around and give it to the car loan person? And the answer is no. Not directly. What they do is they take the cash you just gave them, they stick it in the safe, and it's cash, right? Now, is cash an asset? Of course it is. Can you borrow against an asset? Of course you can. We do it all the time. Cars, houses, credit cards, all that good stuff. So what the banks are doing is the banks do not invest in the stock market for the most part. You can look it up. And I can tell you, Tier 1 capital, and as a bank board member, I can tell you, the stock market is not one of the options. The bank is investing with their reserves. FDIC won't allow it, okay? So they're earning compound interest on our deposits. That's their primary source of income. Borrow against the cash they hold to earn more. So can you. In this next segment, I'm going to talk about how you can create that cash flow for you with your money, take control of your money, and change the financial future of you and your family. Again, register for our workshop in Chicago on January 18th or in Phoenix, January 25th at yourpersonalbankworkshop.com.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We've been talking about a lot of great stuff today, a little bit on the goal setting from the previous show. And again, I encourage you, if you want to really listen to it's the old show, I should say. Check it out. Go to yourpersonalbank.com, and it's the December 31st show. We talk about goal setting and how to make those New Year's resolutions stick. And then I've also, again, in that same thought process, have encouraged and challenged people to learn something new this year. You know, that's to improve. And of course, Your Personal Bank, for most people that I encounter, is something new, fresh, different. It's a tool they're not using. Maybe they had looked at it before. The products are so much better today. The numbers are better today. People keep living longer, depending on when you looked at this. So things are better than what it was before. So it's even a better solution, a better tool. And again, I find most people I encounter do not use this tool. And so it's like they're missing a tool in their tool bag that could, their financial tool bag, we'll put it that way, that could really enhance their financial future for themselves, their business, their family, create a legacy, get tax favored benefits, all that good stuff. Okay. And so I've really talked about how your how to think like a banker versus an investor. Now I want to really touch on how does your personal bank work. And again, if you want more information on this, I encourage you to register at one of our workshops. We've got 2 free workshops coming up in Chicago on January 18th and Phoenix, Saturday, January 25th. Go to yourpersonalbankworkshop.com to register. It's free, 10 to 1. I'll spend 3 hours going into in depth how your personal bank works and how it can make a difference again for you and your family and your business. So again, I talked about thinking like a banker versus an investor. You know, banks don't invest in the stock market in general. They earn interest on our deposits. You can too. Okay, I want to show you how you can take control of your money. What does your personal bank do? It's really quite simple. Some people try to make it more complicated, and you can look up online and see all these kinds of things, but here's the reality. Your personal bank creates an asset that's guaranteed and insured. And in these days, and there's a lots of uncertainty out there in the economy and the markets, and to have something that is guaranteed and insured just makes sense for a lot of people. Particularly, again, a lot of the people that I work with and encounter. One of the things I always talk about is repositioning assets, and this would be what would be considered a non-correlated asset. And why is that so important? See, diversification has become sort of the mantra or buzzword, if you will. But yet, if you look at it over the past, a few decades, diversification is kind of, the meaning of the word, in my experience, in my opinion, has changed. You know, diversification used to mean you had non-correlated assets. What do I mean by that? Well, a non-correlated asset is one that has nothing to do with the other and doesn't move like the other. So, a lot of folks had a lot of situations where, the stocks and bonds would be non-correlated, or stocks and real estate would be non-correlated. In other words, if one went up, the other went down, and vice versa, often. And 08, 09, kind of the experience that most of us went through, unfortunately, Wall Street got involved with mortgages, credit default swaps, and all that kind of stuff. Got much more involved into real estate than many knew about at the time. And, of course, the real estate and stock markets, both, for a lot of reasons, both crashed. And we had a tremendous hopefully a once-in-a-generational experience. But many of the assets, for the most part, the vast majority of cases, when I was looking at statements through those time periods, just about everything, with very few exceptions, lost value. So in other words, they were all in correlation. They were all aligned with each other. They all moved. The analogy I use is like a rising tide raises all ships and a lowering tide lowers all ships. And, for the most part, their accounts, their investments, for the most part, all went up or all went down. In 08, 09, of course, all went down. What's a non-correlated asset? For example, something's guaranteed. One that's familiar to people are things like CDs. Now, I'm not recommending CDs today because the interest rates are so low. But if you go back a decade or so, interest rates were pretty decent. And the times like when I would go to meet with clients after that, during that 08-09 time frame, I could tell, it was kind of interesting, I've been doing it so long enough, that within 30 seconds of sitting down with a couple, for example, I could tell if a majority of their assets were guaranteed or not, just from their demeanor. They were stressed out, they were worried, they were, didn't know what was going to happen. Hey, the markets they recovered over the past decade or so after 08-09. Overall, have gone up tremendous, the longest bull market in history. But which is great. I'm thankful and that it happened that way, and most people are. But at that time, nobody knew that was going to happen. They weren't sure what was going to happen. So there was a lot of stress involved. My point is they had a non-correlated asset. They had some monies, whether it was in CDs or some fixed annuities, those kinds of guaranteed type of accounts, that they just weren't worried about it because they knew it wasn't going down. And there's a difference when I run into folks who the vast majority of their monies are subject to risk, their demeanor, their stress level, those types of things, versus those that have some of that protected or in a non-correlated asset. And now what you're doing is truly creating diversification, because that non-correlated asset, that asset that's guaranteed and insured, is not going to go down, for example, if a market correction occurs. So those are one of the things, like I said, to challenge and encourage people to learn about something new. One of the things I just spoke with a client this last week who has a significant amount of money in the market, also has significant funds in a couple of personal banks with him and his wife. And he's pretty excited because he stated to me he was concerned about where things were going, trade wars and all kinds of different things. And he was comfortable knowing he had this money over here that wasn't going to be affected by that. It was truly a non-correlated asset. And instead of moving to cash, like I know a lot of people do when they want to get out of the way of a falling market, the challenge there is if moving to cash, it means the money's not doing anything, right? It's not losing. That's a good thing. But it's also not gaining. Well, here, a personal bank gets credited, right, currently 5%. There's some costs of fees and things involved, of course, like with anything. But at least, if he's making 4.5 or so, in his case, that was the case. Hey, would you rather, as he put it, I'd rather make my money making some money. Of course, that's in his case because he was doing it correctly, tax-free, income tax-free, I should say. That's better than just sitting in cash and doing nothing. And he's like, yeah. I mean, he's happy about that. So my point is, having an asset that's guaranteed and insured creates that non-correlated asset, which is a powerful key point to have some of those funds set aside for that. The one last thought on that, having that guaranteed and insured or non-correlated asset, it's not going to be subject to market risk, is this. In retirement, when we do retire, we do know we can have a pretty good guesstimate. We can calculate with a reasonable rate of inflation and such like that, how much we're going to need to live on. And I'm talking about not wants, I'm talking about needs. We all know we're going to need food, clothing, and shelter, right? Those are three basic needs we all have. And a reasonable calculation can be made to estimate how much your costs of living are going to be, the basic needs. And one of the things I encourage people to do often is not to risk the known needs. Why put at risk when you know what you're going to need? Why not lock that down in something that's guaranteed and insured, like I said, that's going to be there when you need it? And you know you're going to need it. If you want to play with the rest, fine. I mean, you want to, try to grow a nest egg and do all those kinds of things, but don't risk what you know you're going to need. So whether it's an index annuity, for example, there's a lot of great products out there in that arena. Your personal bank, using the high cash value life, which I'm going to talk about in the next segment, can be a great tool. My point is this: don't risk what you know you're going to need. Again, register for our free workshops. Chicago, January 18th. Phoenix, January 25th. yourpersonalbankworkshop.com. And if you want to contact us for any more information, contact us at yourpersonalbank.com. See you in the next segment.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
All right, we're rounding third. We're coming into our last segment. We've been talking about a lot of great stuff today. We've been talking about goal setting, those New Year's resolutions, how to make them stick. Again, go to yourpersonalbank.com, listen to our previous recorded shows. If you want to listen to a great goal setting session I've been teaching for about 2 decades, the December 31st show, check it out. Also, we've been talking about how to think like a banker versus an investor. And the last segment, we were talking about non-correlated assets. What is a non-correlated asset? It's really quite simple. It's an asset that doesn't respond or behave depending on the economy, market, taxes, those various things that affect the value of assets. It doesn't correlate with the market. And like I said, fixed index annuities, high cash value life policies are guaranteed and insured, and those are a non-correlated asset. They'll continue to grow based on what type of account you set up, whether the market takes a correction or not. And it's nice to have some of those non-correlated assets, those guaranteed and insured type of accounts, to cover those known needs in retirement. You know how much you're going to need. We can calculate that with inflation and such, and your age and whatnot, and your lifestyle, if you will, and cover those food, clothing, shelter, those basics that you're going to need. And if you know you got that covered and no questions asked, that's covered when you retire, then if you want to be more aggressive and risk some of the other stuff to grow a nest egg with the extra and overage, hey, go for it. That's a nice combination that I find works for a lot of people that I work with, a lot of clients. The last thing I really want to touch on, and I've been trying to lead to this, is how does your personal bank work? So let's finish this up. Again, your personal bank is an asset that you create that's, again, guaranteed and insured. It's that non-correlated asset we referred to in the last segment. You have access to your capital, basically day one. So this is powerful for those that need access to monies. I've shared this on many, many previous shows. Access to capital is a huge key in being successful personally and business-wise in business. Just in life, your financial life. Because stuff happens. There's 2 things that happen. Stuff happens. Bad things happen in life that cause reductions of income, unexpected expenses, all those kinds of things. That's just life. That happens to all of us. The other reason is you want to have access to capital is for opportunities. If you see an opportunity comes down your way and you say, wow, that's something I'd like to take advantage of. I feel like I could make some money with that. And you don't have the wherewithal, the access to capital to take advantage of it. That's really frustrating. And that's what holds businesses back and holds people's finances back personally and business-wise. In fact, the Small Business Administration talks about that being one of the top 2 reasons why businesses fail is lack of access to capital. Okay? You want to earn interest on your asset into the borrowed funds. This is powerful. I'm going to touch on this a little further. And, of course, you can create income tax-free growth and withdrawals if it's set up properly. Bottom line is you can make 2 to 16 times, in most cases, more dollars to spend in your lifetime using your personal bank versus not. I used to get frustrated with people when they wouldn't get the concept. And then what I realized is they just didn't understand compound interest. And most people don't really truly understand the power of compound interest and the ability to use it, yet have your money grow. Your personal bank allows you the ability to use your money, yet benefit from the compound interest, unlike just about any other financial tool that exists. Again, you want to learn more about compound interest, go to yourpersonalbank.com and listen to one of the previous shows where I talked about in depth compound interest. Okay? This is, again, all in the idea of the thought of learning something new for 2020. This is new, fresh, and different by most people as they state to me when I talk to them about this. Now, I've mentioned this a few times. The tool we use is a high cash value insurance tool. And when I say that, and people say, why? We could use just about any financial tool, frankly, for the personal bank concept. But this is the one that works the best, and it's a process of elimination. Why? First of all, compound interest. We want our money to grow every year, right? Well, that takes a lot of investments out because they vary in what they're going to grow, not consistent. We don't want risk of loss. You don't want to borrow against an asset that can lose value, do you? I sure don't. That's a recipe for disaster. So that takes anything off the, market related off the table. We want liquidity. We want access to a good percentage of our money, at least half or more. By the way, in a previous show, I even shared one of the key secrets to knowing if you're looking at the numbers and you're looking at a personal bank, do you have access to half your money day one or more? If you don't, it's not structured correctly or you're not looking at the right product. That's a quick, simple thing to look at to determine if you've got a good example that you're trying to compare. And if you want to compare, please contact us at yourpersonalbank.com. We'll be happy to give you a free, comprehensive comparison. No cost, no obligation. It's like a second opinion. When the doctor says you need surgery, should you get a second opinion? I think so. And most people would agree with that. Access to funds. Bottom line, we don't want any penalties, age restrictions, or other things like that. So the whole IRA 401k world gets knocked off the table. Oh, by the way, in the liquidity department, CDs and some annuities have the safety, but they don't have anywhere near that kind of a liquidity, so they're knocked off the table. I get this asked all the time, is this an annuity? I said, no, it has nothing to do with annuities. I'm not against them. There's a lot of positive things there, but the personal bank concept is not an annuity. Also, or the tool we use, I should say. Last thing is, if you set it up correctly, you got income tax-free growth, income tax-free access to your money, and you can pass it on that way, income tax-free. Okay? Again, it has to be set up and used properly, but that absolutely can be done. What's our biggest challenge when we share this concept? Sometimes when I say to people, look, you need to, the tool we use is a high cash value insurance tool. And some people think of, oh, gee, I've got the home, the auto, the last thing I need is another bill. Stop listening and miss the entire point. See, the thing is this. Everything you know about insurance, turn it on its ear. Flip it on a dime. We're using it completely the opposite to how most people view and use life insurance. See, most insurance, I love doing this when I'm in a workshop. And like I said, I've got 2 workshops coming up here in January 18th in Chicago, Phoenix, Saturday, January 25th. Go to yourpersonalbankworkshop.com, register for free. It's 10 to 1. We'll go into depth on this. Love to meet you, answer any questions you have. My point is this. I love doing this when I do a workshop, and on those 2 dates, on the 18th in Chicago, on the 25th in Phoenix, I will ask the question to the group there, and I'll say, how many people here have life insurance? And I'll get half or more of the hands to raise typically, and I'll look at them and I'll say, no, you don't. And a lot of people look at me kind of funny. Some even start trying to argue with me. I said, no, what you have is death benefit protection. You're paying a premium to protect a loss of income or various things. Something happens to you, your heirs get a check. Now, I'm not against death benefit protection. Many of us have those death benefit protection needs, as I do. I have a family, I have a business, I have those needs, and I have some of that death benefit protection. But that's not what I'm here to talk about. I'm here to talk about how to maximize cash growth, tax favored, have more money. And so the bottom line is this. It's real simple. How does it work? Think of a teeter-totter. Most insurance policies are structured on one side of the teeter-totter. I know it's radio, but if you can put this picture in your mind just for a minute, one side of the teeter-totter, you got cash. The other side, you got death benefit. Most policies are set up where you have minimum cash. Term has no cash. And you're maximizing death benefit. And that's what it's about. It's a death benefit protection tool. Flip the teeter-totter the other way. We're maximizing cash and minimizing death benefit. It's just that simple. It's no more complicated than that. Again, if you want more information on all this and how it works, and you want to learn something new about your finances and change your financial future for you, your family, your business for 2020, contact us at yourpersonalbank.com. We'll be happy to share with you how this works, send you more information, and show you how this could work for you and your family. And please register at yourpersonalbankworkshop.com for the workshops on January 18th in Chicago and Phoenix, January 25th. Love to see you, love to meet you, answer any questions you have. And as always, tune in every Tuesday at noon to Money Radio, 1510 AM or 105.3 FM.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.